Welcome to the Property Investing Roadmap podcast.
I would say once the thought is in your head, we would like to invest in some property, have the conversation.
Make time and discipline your friend.
I'm your host, Damian Collins, here to help you navigate the twists and turns of property investing.
The true investors are the ones that ask the right questions but then make a very quick decision, and they're the truly wealthy ones.
For real success, you need a real strategy.
Buckle up as we hit the road with expert tips, real life stories, and the 9 key steps to help you plan, build and optimize your property portfolio.
No one's going to invest to make a loss. You're going to make profit.
Welcome back. Today we're talking about one of the biggest misconceptions that we see in the property market, and that's that people think you have to sell a property to realise your profit and make a gain. Now, I've got plenty of my own war stories I'm going to get into about all the silly properties that the properties weren't silly. I was a silly one and sold those properties. We'll talk about some of those today as well. And it's interesting how that creeps into the market, because most people in real estate are remunerated on the basis of buying and selling. That's agents. And they do a great job buying or selling, but that's how they get paid when there's a transaction. The government gets paid stamp duty when there's a transaction. And also the federal government gets a capital gains tax on investment property. So it's no wonder everyone is telling us to buy and sell. But we're going to talk about this today. And back in the hot seat with me is Robin Ram, Head of Research and Property Acquisitions at Momentum Wealth. Robin, great to have you back again.
Thanks for having me, Damien. And this topic is a particular one of interest to mine. My background of 23 years has seen 16 years as a selling agent. During my time as a selling agent, plenty of people have asked me, Robin, should I sell this asset now? Short-term thinking as a salesperson, I could easily say, yes, market's great, you can get out of this property now, got my commission, move on. Long-term thinking is what's in the best interest of this client, how can this position them for the future? Too many agents, in my experience, focus on the short-term win without the bigger picture.
Yeah, and that's it, isn't it? Unfortunately, the way the industry is driven, it is encouraging people to buy and to sell, because that's how everyone gets paid, as I said. But look, we're going to talk about, there will be some times when it does make sense to sell. We'll talk about some of those options, but I look back at some of my property investments and just give you some background. When I started in real estate, back in my early 20s also, I wasn't an agent. I was full-time in property investing and developing. And I had to sell some properties. When you're a full-time investor, trader, I learnt pretty quickly you can't eat bricks, right? So if you're going to have pay for meals and live, you have to sell some. But I foolishly sold everything. I used to buy and sell and trade, and it took me years and years and years to realise, well, that was my profession. Maybe I needed to sell some, but a lot of them I should have kept, and I really do regret that. Some of those that would have been worth around or cost me around $120,000, $130,000 are now worth $800,000 or $900,000. But anyway, you can't change the past; you can only change the future. So we're going to get right into that today, and talk about why you should buy and hold, and also importantly, there will be some times when you may need to sell, and we'll talk about where those things are. But I want to talk, Robin, about a scenario of an investor who bought a good property, investment grade suburb. They've made some good money over a 5-year period. They want to realise that through selling. Tell me why that necessarily isn't a good idea.
Oh, in my experience, a lot of people are looking at just that number difference. I paid this much for a property. I can now get this much when I sell the property. They forget the entry costs. They forget what it took to acquire this property, what it's cost to hold them, and also now the exit costs of that property. So when they're looking at the $200,000, $300,000, $400,000 potential profit they've made in that acquisition, they're now forgetting, once that they've actually realised that money, what's actually come off that investment, plus what could that investment do had they have kept that opportunity for the longer term. As you said a bit earlier, when you were acquiring properties around that $120,000, $130,000, the beginning of my career, properties were going around $90,000 23 years ago. I remember setting a record in a suburb for $150,000 for a 3x1 house, and having fellow real estate salespeople telling me, oh, you've ripped those clients off, they're never going to get their money back. So seeing what property can do, how cheap it was over the last 23 years, and considering what this can do now in the future, it's really opened my eyes.
This doesn't just apply to the real estate market, does it? Because I know one of the most successful investors, if not the most successful investor in the share market, is Warren Buffett. and he just buys and holds. He just buys great companies, and here we're talking about real estate, buying great real estate, and just holds them forever and ever, and lets that miracle of compounding take its course. And he's now worth $100 billion, so you can't argue against that sort of success, can you? So do you want to just explain what the buy and hold strategy is, and maybe just some of those key points around what drives the profit from that strategy?
Yeah, I think one of the best ways I could explain this is what I sometimes do with clients when they come into the office here, have a potential chat around what they're looking to achieve and the styles of real estate investments that can be that vehicle for that wealth creation for them. I quite often reference an Home Buyer magazine from 1978, where there's a particular suburb in Perth where you could buy a 3-bedroom, 1-bathroom house. The price is $62,000. So that house from 1978 till today's market, you're looking at about $750,000. That being a good brick and tile asset, relatively new, would get good stable tenants, long-term excellent growth just to buy and hold that. Comparing that to a different style of investment focused on capital growth, 1978 buying a particular suburb of Perth, the western suburbs called Dalkeith, where you could have acquired for $1,000 more in 1978 a property in Dalkeith, which you'd be looking around $3 million for that property now. So the value over time has been significant for both of these investments, but one outperforms the other based on the location, the desirability. So that buy and hold strategy, either way, is excellent, but buying the right one for the long term puts you in an excellent financial position.
And it just shows, doesn't it, that over that longer term, that one that you mentioned that is now Dalkeith $3 million, that's probably only a couple of percent per annum extra capital growth, but that continues to grow every year. That 2 to 3% extra capital growth is what drives that really substantial outperformance, doesn't it?
Yeah, when you're looking at compound growth, one of the easiest ways to explain that is, let's say you acquire something for $100,000 back in, the year 2000 in the Perth marketplace, and you buy that property, the market goes up 5%, that $100,000 asset is now 105. The next year it goes up another $5,000, that's now at 110,250. And every year that property keeps on going up based on market conditions. But over time, that 2, 3, 4% difference in growth makes a huge difference to your end result. Over 30 years, one of the least performing suburbs in the Perth marketplace, at least, has gone up 341%. So with or without the help of expert opinion, if you just buy something and hold on, the worst performing suburb in Perth has still gone up 341%. The best performing suburb has gone up 992%.
Wow, that's substantial, isn't it? That's pretty much triple the value. Comes so much down to asset selection, which we will cover in other podcasts. But more importantly, it's time in the market, isn't it? Just being there, and we'd all like to buy at the exact bottom and sell and get to that exact top, and that's the time to maybe get out, or even if it's just holding long term, we'd always like to buy that bottom. But the reality is, none of us are going to pick the exact bottom, are we? And it's more about time in the market than necessarily timing.
That's correct. So when you see those averages in Perth and how they, for 1 to 3 to 5 to 10 years time, make a difference, and then when you see that exponentially increase through the 20 to 30 year time span, you really realise that buying the right asset that feels comfortable to you, for, as we spoke about, for the right style of investment, so you can hold it for that long term, becomes crucial.
And look, we always got to keep this in context. So even though we're talking about assets in 1978 might have been 60-something $1,000. Yes, we know that the average wage back then was a lot less, and mortgage rates certainly might have been higher than they currently are. But somebody back in that time period bought those assets, and if they'd held on to them today, 40 plus years later, they're up substantially in capital growth. So I might just want to have a look at another one that was in the press, and it was a property in Point Piper. Do you want to tell us that capital growth story? I wish I'd bought that one. Sadly, in 1977, I was still very much in early primary school, but nonetheless, tell us about that one.
That one is an exceptional rate of growth for that property. Point Piper being an excellent location within the Sydney marketplace, premier spot to be owning an asset, and those clients, or those not clients, but those particular home buyers, purchased that property 1977 for $325,000. So at the same time in Perth, that would have been, I would say, our price would have been around the sort of $80,000, $70,000. So it was a considerable investment at the time. That one has just gone under offer, I believe, earlier this year for $80 million, with nothing changing to that asset.
And that's incredible, isn't it? $80 million. Now, if that was their home, I don't know if it was, that would be capital gains tax-free. Happy days. That's the no one needs to work ever again.
That's just amazing.
Go and buy some investments and go and live the high life. But interestingly, that is compounded capital growth of somewhere around 13% per annum. And there would have been other assets in Sydney market that maybe did 8% per annum over that time. Just that extra 4 or 5%. I mean, it's a significant amount, but that's where that's just made someone absolutely tens and tens of million extra, hasn't it?
Absolutely massive difference. That little bit of value over time, and then you do that yearly, again, year after year after year, that end result being significantly different. Buying in a marketplace for a client, the worst performing asset we could buy someone based on the last 30 years would still be 341%. One of the most regular suburbs that we've been purchasing in the last 12 months, that particular suburb for a blended investment has returned about 651% for clients. So that's been an excellent performing asset for someone to buy, be comfortable enough to hold good yields, good returns, and then 651%. So they're in a much better position. Similar entry prices, huge exit prices.
Now, when we look at the market today across Australia, people will be out there saying, well, it's all very well for people back in the 1960s and 70s because property was a lot more affordable. It's now, here we are in the 2020s, and I can't get in the market. It's too expensive. And I appreciate it's not easy. It's not easy to get in the market. Property you certainly wouldn't say is cheap, would you? But this problem or this perception has been around forever and a day, hasn't it? That people can't get into the market, it's unaffordable. And it came across my desk, which I thought was interesting, from August 11th, 1963, well before even I was born, Robin, that people said they couldn't get into a property. Do you want to tell me a bit about what that article was about?
Yeah, I like to see that one too. I think it's a entry price in the market was about £4,500 at the time to purchase a property. And the article focuses around how unaffordable property prices are for first home buyers to enter the market when people are asking £4,500 for a property. So I think, and I'm a bit of a sucker for some of those reality property shows, unfortunately. And I did hear a line I actually really liked the other day in one of these shows based in America. And the line was, everything is expensive in today's prices. And I really liked that line because in the time in 1960s, they were arguing about how expensive £4,500 are. Today, the average marketplace where that particular property was purchased, it's about 1.4 million 60 years later. Yeah, so what a massive difference. And now 1.6 million, everyone's arguing about how expensive the market can be, how hard it is for first home buyers to enter into the marketplace. So again, it just shows that the common themes are there, but the value over time of money changes, the value of incomes change, the value of life changes. And all of a sudden, we're now 30 years down the track and we're still talking about expensive, but everything is cheap in hindsight. So I've had so many more discussions with people I've sold houses for over my 16 years as a salesperson based on, I wish I held on to that. Look at what that one's done now. I wish I held on to that. So as you said, you've got plenty of war stories on, how you've sold assets and you look at them now and you look at what some of the prices are. And, just holding on a couple of those extra properties would have made a massive difference to a position now and what you could choose to do with those assets if you still had them.
Yeah, I finally wised up when I was about 30 and I started holding a lot more property, which I'm glad I did because that was we had some really strong capital growth after that period of time. But it was just the sentiment in that as a developer particularly, which I was back then, you had to take your profits. You had to move on to the next one. And it wasn't until I realised, well, I could actually get a lot of my money out on this property without paying any capital gains or income tax by leveraging against it. And do you want to just tell people a bit more about that? You mentioned there that property grows 5%. And let's say it's a $800,000 property and it grows $40,000 next year. You go, well, that's good and solid, but people aren't necessarily going to get excited about that. But when you look at your return on equity, let's say you put down a 20% deposit, I say 160,000. That 40,000 is 25% return on your capital, isn't it? So just tell us a bit more about leveraging and how you can use leverage to get into the next property rather than selling and taking your money off the table.
Yeah, your book explains it very well, Damian. And the example I think really resonates for people is putting in a deposit for a property versus putting in the whole amount of money and what that can mean over time. So if an investor puts in, let's say, the $800,000, a 6% return, that's going to mean that, let's say, if that goes 6% a year, excluding some of the costs that go out just for ease of calculations, after 10 years, that asset could be worth about $1.4 million. So that's a gain of $602,000 for the investor. If that investor put that whole amount of money in for that property, they're now looking at a return of about 79% on that money. Had they've only put a 20% deposit down, so that's a $160,000 deposit, and the same asset then sold 10 years later, that would be a 395% return on their investment, plus they still have their initial $160,000 there. So leveraging the growth in the marketplace, getting that compound interest, and then utilizing that equity that you've got in that property to realize some other property goals can be an excellent way to build that over time and to realize the value of compound interest for multiple assets.
And that's huge, isn't it? That's 395%. Now, no doubt, on the way through, you'd have some negative cash flow potentially, and the tax system helps you with that, and we cover that in other podcasts. But the return is massive, isn't it? 395% versus 79%. So it's important to, obviously, leveraging does involve risk, right? If the market goes backwards, that's something we've got to take into account. But certainly, if we buy well-selected assets and use that leverage wisely, that's where we get those super profits, and that's how you get into your second, third, fourth, and fifth properties, isn't it?
Yeah, and unfortunately what I've seen over the years that so many people, when they've had a bad run in the marketplace, or they've had some, let's say, a bad year for their property, they've had to put a little bit more money in than they planned. The short-term pain is, I've put money out of my pocket this month, this year for my property, and it hasn't really performed. They start forgetting the bigger picture. So it would be so wonderful if every client could look at it and going, what is the long-term pain if I actually sell this rather than hold on to it? Because that long-term pain is kicking themselves for an asset that would have made them hundreds of thousands of dollars more if they just would have held for that extra 5 to 10 years, rather than selling that investment because it cost them an extra $5,000 this year, and they're saying, well, yeah, it's done 5,000, it's not really performed much on value, I'm out. And then all of a sudden, 3 years later, the market goes to another upcycle, and they're just kicking themselves that they didn't just go through that short-term pain to realize that longer-term goal.
Yeah. And that's really important. It's time in the market, and that was one of the lessons I learned from my own experience. You know, it's very easy to get stuck in the here and now, and the assets maybe, the market's a bit flat, perhaps where you are, or you've got some expenses on the property, and it's very easy to hype yourself up and get a bit of a dopamine hit. So I'm going to sell that one and go and get another one. And I remember I did that, and I said, well, that suburb over there is going to do better than the suburb I'm in, and convinced myself I should sell it. So I sold it. And it wasn't until later, which was a bit silly of me, but I sat down later and said, I've just paid all this capital gains tax. I've had this property for some time. I've just paid a selling agent, which is fair enough because they did a good job and got me a good price, but I've had to pay a selling agent. Capital gains tax, selling agent. Then when I bought the new property, it was 5% stamp duty, which is another big hit. So all of a sudden, I've lost somewhere in the order of 20+% of the capital value I had. And I did the maths later, and it's in the book, even if I went back and even if that property outperformed by a couple of percent per annum, it was going to take me nearly a decade to get back to break even. And that was when I really learned, you buy a good quality asset, you don't sell it, unless we'll talk about the couple of times you do need to sell it, or you should think about selling it. But just buying it, and don't get caught up in the market hype. It's in the paper. This is the hot suburb, and this suburb's going to go better. When you're buying that asset, we've got to be thinking about the long term, don't we? And that's 20 years, 30 years. It's not about what's going to happen in the next 12 months, is it?
Yeah, it's reminding ourselves that in the context of real estate investment, 10 years is a short investment. Yeah. We're aiming for at least 10, ideally 20 to 30 years as a whole time for whatever asset someone purchases. So is this the type of property that you feel comfortable holding for the long term?
Now, Robin, when we do strategic work for clients, we do sometimes say, look, you might think about selling that property. And that's it's not that often, but sometimes there are reasons, aren't there? So let's just talk about, I'll talk about the first one, which I mentioned there, superior alternative return. So let's say we think of properties in a suburb that's not necessarily going to perform as well as another. But we take that in context, don't we? The fact of all those transaction costs. So just tell me, how often does that come up that we go, well, it's a really ordinary suburb and there's going to be better returns somewhere else? How often does that come up, or do we generally go, most of the time, even though there's maybe better investments, given where you're at, you might just stick with what you've got? Yeah,
we will look at age as a fundamental difference. As you said, it took 10 years to make back some of that money. So if someone's approaching their investment journey and let's say they want to exit within 5 to 10 years' time, it's very unlikely that we would recommend that anyone would sell an asset in that period of time just to be buying another asset. What we do sometimes recommend, if people have still got time in their real estate journey where they've still got a plan to hold something for 20 to 30 years, we've given a recent example of a client that's had 3 regionally located properties, have performed very poorly over capital growth. They've been quite strong on the rental yield side of it, which has been the only plus for that investment. But having those three assets stop them being able to buy a better quality asset that will realise better long-term capital growth for them. So these clients in particular had to sell those three properties to free up their borrowing ability so they could get into one property that would perform better. That one property with a better growth rate, better history of growth, would also mean one lot of property management fees, one lot of council rates, one lot of water rates, one lot of land tax, rather than three. So not only were they going to get a better asset that produces better over time for them, but they're now setting down their costs as well.
Yeah. And look, I want to give an example too of what a lot of people make a mistake. They listen and they say, yeah, I want to hold my property. But this is one time when you really want to think about selling the existing asset. This is when you're trading up your home. And what we sometimes see is someone will come in and they might have a home, let's say we'll go with $1 million, keep it not round numbers, and let's say they've got to that stage in life, they've pretty much paid off their home loan. And they go, well, let's rent that out and then we'll go and buy another home. So we'll go and buy a home for $1.5 million as an example. The real problem with that one is that the mortgage then on the old home, because you didn't have a mortgage, despite the fact that you leverage against that home to buy another home, the purpose of the borrowing is actually for a new home. So all of a sudden you're lumbered with this asset, which it might be a good investment of $1 million, but the rental income is going to be fully taxable. You're going to get zero deductions for your debt because the fact that you've leveraged against that property to buy a home, not for investment. People think it's a security is that home, that property that's now investment, I get a deduction. You don't. So in most cases, it's not necessarily a good idea to hold your home. It's one of those ones where you want to sell one, get into another. Yes, upgrade your home. That's great. But for most of the time, particularly if you've got equity in that home, the debt will become that you use against that property to buy another home will be non-deductible. So that's one of the other reasons we would say people maybe think about selling. The other one is that neighbourhoods declining. Now, we don't see this in Australia as much as you do in countries like the US, where they can become just a no-go zone and values can drop 30, 40, 50%. We don't often see that, but are there times where we think, well, this neighbourhood's declining for whatever reason and that maybe it's time to take the money off the table?
Yeah, that sometimes happens. An example of that could be an impact on lifestyle. So a desirable location impacted by, let's say, a new flight path coming in, which is going to impact the noise levels considerably. That could be a reason to go, well, maybe I'm not going to get the same returns, not as livable, so I might want to exit out of that before the reality sinks in for people and the planes start flying overhead. There could be another one where road widening has come through. Quite often areas and precincts can be subject to rezonings, so areas can change a little bit from a residential feel to more of an industrial feel or commercial feel. So those could indicate shifts of desirability for a certain pocket. It comes with certain pluses, like yes, maybe you're closer to work, but the area that you want to purchase in is something that's going to be attractive to home purchasers in the future, not just a fellow investor. So if you can exit your property and be able to sell it to someone who's going to appreciate living there, that's sometimes the best returns that you're going to get compared to someone who's looking purely from an investment angle. So those could be another two examples.
And I think you mentioned some of those property shows, the renovation shows where everyone's excited and they go to auction and they obviously get a prize if they achieve a certain price point and they're selling them. And people get hooked on that. They want to renovate to sell or develop to sell. Look, my take on that one, having done it myself, is that being a developer, renovator is really a full-time profession because it's about timing the market. You've got to get in well at a good price. You've got to develop and maximize the end values where you can, but also minimizing costs and time frame is a killer. And for most people, if you've got a full-time job or whatever you're doing, you're not going to be doing it very well, are you? So, look, there will be times when clients will say, look, I've got a development site and I want to maximise the returns on that. Maybe you will build 4 and hold 2 or 3 and maybe sell 1 just because you've got a lot of debt on that property. That kind of makes sense. But for most people trying to trade in the market, it's like trading shares. You've got to be a professional at it, otherwise you end up burning your money. And my advice to anybody listening to this podcast is, if you've got a site already that's got development potentially, you might then develop it, but aim to hold most of them where you can, and you might drop one or two off just to pay down some debt. But that's generally what we would recommend to clients, isn't it?
That's correct, yeah. We've done a number of scenarios where we've looked at some potentials for clients to do some developments in the current market. We've seen some indications change. We've medium density zonings we've changed in the Western Australian market. We've seen local shires become pro-development to anti-development. We've seen a whole bunch of number of factors that have come through. We've seen some of the best returns for our clients, though, when they buy these assets that have the development potential, which means not only are those sites going to be attractive to home buyers in the future because they're on good portions of land, but they're also going to appeal to investors. So on the exit of that property, you're attracting more competitive buyers, which will push up that price for you in that exit.
Look, that's a wrap for today. Thanks again, Robin. You've been fantastic as always. So much expertise and knowledge after 23 years since you first got into real estate. Really appreciate you coming on. If there's one thing I'd like you to take away from today's episode, it's about time in the market rather than timing the market. Now, yes, we'd all like to have purchased at the bottom of the last cycle, but no one rings a bell. We don't know when that's going to be. We all would have liked to have purchased 20 or 30 or 40 years ago when property was a lot cheaper. Well, you might be looking back in another 20 years wishing you'd bought now. Focus on buying good quality assets in great locations that will give you that compounding capital growth. Just a few % per annum will build wealth for you. You can leverage against that, get into your next property, and that's how you start to build a property portfolio that will give you an income from property for life. Thanks for tuning in. If you're enjoying the podcast, please take a moment to rate us to help others discover the show. Please note the information shared on Property Investing Roadmap is general in nature and doesn't take into account your individual circumstances. The information is for educational purposes only and should not be relied upon for investment or financial decisions. Always seek professional advice before deciding whether to invest. Today's guests are representatives of Momentum Wealth Property Advisory Proprietary Limited, licensed real estate and business agent in WA, RA 82976.